Alrighty, it's 1 o'clock on the East. Good afternoon from New York. We're going to get started here. Good morning to those to the West, and good evening to those to the East across the pond. Thank you all for joining me today. We're going to be recording, as I said, for those who registered but could not make it, and for posterity for anyone who would like to replay it. We have a late roster change, as you can see on my screen here. My friend and colleague, Joe Childrey, founder and chief investment officer of Probabilities Fund Management, is traveling and unable to attend or join us today. But pinch hitting for Joe is another good friend and colleague, Dave Rabin, president of PFM and Probabilities Fund Management, and an industry veteran. After I run through my market outlook, Dave's going to say a few words about Probabilities Fund and the other things that we're doing together, how they construct portfolios using the Almanac, a lot of it based and inspired by the Almanac and our research and analysis. And after that, Dave's going to lob me a few softball questions to start us off, and then we'll open up the floor to all of you to fire away any hardball questions you have, or about anything. If you want to talk about the Giants, potential new coaches, that's fine too. But you can use the chat, the question box. A couple people there. Hello, good morning from Australia. Are in there, so you guys should know how to use that. So for the uninitiated and as a review, I'm going to run through a little background of who we are and what we do and how we approach the market, and then we're going to recap some of the action in 2015, some current action, a little look at the positions that we have in the newsletter portfolio, and then a look at our outlook and forecast for 2016. Obviously, as you all are watching the market now, that's potentially impacted by current action. We'll include some of the current indicator readings, and we'll see what's in store for the rest of the year. But first, a word from my lawyers. This is for informational purposes only. It's not an offer to buy or sell anything. Do your own due diligence, consult with your advisors, etc., so forth. Use your common sense, and let's jump right in. So a little bit of background for those of you that don't know, we've been doing this for about 50 years. I will be 50 later this year. And this is a picture over here on the side of the first edition, the 1968 edition, which came out in 67. Being born in 66, and the Hirsch organization initially incorporated in 66, I was born, raised, weaned, bred on seasonal patterns, charts, stock analysis, etc., so forth. The current edition of the Stock Traders Almanac, the 49th, the same age as me, is out wherever books are sold. If current subscribers get one as part of their subscription. There's the Superboom book that I put out a few years ago based upon a forecast we made initially in 2010 for the next secular bull market and Superboom to begin probably in about 2017, 2018. I'm one of the few that still thinks we're in a secular bear, and it was based upon a forecast Yale put out in 1976, calling for a 500% move from the 74 bottom based upon the prior action from World War II and World War I, and I'll show you a couple of charts at the end. Then we also have this little book of stock market cycles, which is sort of a sophisticated book for dummies that has been relatively well received. Kind of happy with it. It was a fun sort of lighter book to put together, covering all the seasonal patterns and cycles that are relevant from all the different years. We sort of stick to a four-year cycle, if you will, with the Almanac, and this year being the election year edition. But the little book covers all the years. So just to look back at the Dow 3420, which was the number that Yale had put across the top of the newsletter based upon the 500% move, 6 times the intraday Dow low back in 74 of 570. This was a t-shirt that we had. I still have a case of a little box of these from the 80s when Yale had a conference over in Tarrytown, New York. Lou Rukeyser was a keynote there, I believe, and I was probably running around the pool and trying to cause a little trouble, but not quite fully working in the business at that point. This is a shot of Yale in 78 on Wall Street Week, a proud moment for him and the family. Went back another time. This was basically because of the forecast and that buy call he made back in 74 and the 500% move forecast. So a little trip down memory lane there. A trip of me. If any of you seen me recently, perhaps yesterday on CNBC, which was a nice little hit with Joe Kernan and Andrew and Becky Quick. There's a little more hair here than I have now, but this is a nice shot of me and the big guy back in one of our old offices from probably about 15 years ago, maybe. So it's quite a privilege and honor to be covered in a lot of these places. Currently a Yahoo Finance contributor. I've seen some recent coverage in The Economist. Everyone's been calling me lately, USA Today, some Canadian newspapers. So it's really a testament to the analysis and efficacy and relevance of seasonal patterns and cycles, and something we've been doing for many years. And it's just, it's just sort of a feather in the cap, but also underscores the importance and relevance of seasonal patterns and cycles and historical analysis. So a little bit, our philosophy here is sort of a flip side of the Santayana quote that those who fail to remember the past are condemned to repeat it. We like to say that those who study market history are bound to profit from it. And ironically, I just received a call from Sam Stovall about another perhaps panel to be on. Our friend Sam likes to say that, yes, use history as a guide, but not as a gospel. And that's, how we layer in other disciplines. I don't like to think about things one-dimensionally. We like to look at other trends, fundamentals, technicals, and we'll cover some of that stuff as we move forward. So we've been looking at different patterns for 50 years, analyzing, researching, and testing them. We've looked at every trend imaginable. Some of them have fallen by the wayside, that have stopped working with the changes in society. Some of them are non-correlated. Things like the Super Bowl indicator from the aforementioned Stovall's father, Bob Stovall, great man. One of my favorite quotes from him is that selling a soybean contract short is worth 2 years at the Harvard Business School. He's the one that came up with the Super Bowl indicator. So we update things weekly and monthly, and we construct portfolios in the newsletter, and now in conjunction with our colleagues at Probabilities Fund Management, which Dave will talk about in a little bit. So our process, we sort of start with cycles, seasonals, and recurring patterns, but we do look at trends in the economy, monetary and government policy. We look at internals, some old school market breadth and, new highs and lows and sentiment and different, internal indicators, plus fundamentals. When we pick stocks, we have a nice fundamental screen. We'll show you the current basket of stocks we have in the newsletter portfolio now. And of course, technical analysis, which is finally gaining more mainstream credibility, which is nice to see. A lot of people drawing charts. Saw my friend Mark Newton on CNBC drawing a nice chart, which was similar to this descending flag. I'll show you in a couple minutes. So the major cycles that we look at, the super boom pattern, the super boom cycle is based upon war and peace in the markets and how the market moves 500% following war and inflation. We look at, with respect to secular bulls and bear markets, as I said, I'm currently one of the few people on the planet that thinks we're still in a secular bear market. I don't believe we've had our 1982 moment yet. I think that's coming. Maybe people are a little bit more in line with that or believing that more with the action we've seen over the past several months, and especially at the outset of this year. The decennial pattern, that fifth year, used to be, now it's 12-2 with that loss we had in 2015. Used to be a great, strong point in the decade. We don't follow the decennial pattern as much, not as much a proponent of it, but the 4-year cycle we are. And we'll look at a little bit how two-term presidents are different, especially here in the election year, which unfortunately is not a benefit or a positive for this year. Seasonal cycles are bread and butter, the best 6-month switching strategy, something Yale came up with in 1986. A lot of people are hung up on sell in May and go away. We don't like to sell in May and go away. We do sell some things. A lot of times we sell in April like this year, which is pretty pretty prudent. We also follow and use seasonal cycles for all the sectors and commodities. We'd like to time our stock purchases around the time of the year as well. It's where we get a little juice by getting in after the market's down during a seasonal weak period and starting to tighten up during the end of the seasonal bullish period. Several things I am not going to cover today, but we do touch on throughout the year in our website and newsletter, and also in the almanac, is the quarterly, monthly, weekly, and daily and intraday trading patterns. This is something that the Probabilities Fund uses a lot for their daily bias, their calendar of being long, short, leveraged, or in cash for the S&P 500. And of course, on everyone's mind right now are the January indicators, the January barometer, and the Santa Claus rally, which just failed to appear, and of course the first 5 days, and we'll look at some of that in just a minute. But let's first recap my forecast from last year. Picked up out of the newsletter, but just edited a little bit for shortness. You know, we expected the usual 50% move from the midterm low to the pre-election year high to be below average in the 20 to 30% range. We thought that the economy would be prone to slowing as the battle for the White House heated up, and just looking at the news flow today, it looks pretty hot. We thought we'd get a higher in the first half of last year, around 19,000 on the Dow. Didn't quite get there. We did get 5,000 on the Dow. We didn't get 2250 in the S&P either. And then we thought we'd be moving sideways and make a higher high in the last half. We did make new highs in the first half of the year. We cleared 5,000 on the NASDAQ. Dow and S&P came up a little bit short, not by much. We did only get a 19% low to high move for the Dow, 22 for the S&P, and the economy is arguably slowing right now. So, and the battle is raging for the White House. So arguably not a perfect forecast, but not too shabby. One of the other things that people are talking about right now is the 4-year cycle. The first pre-election year since 1939, when German tanks invaded Poland, that the Dow Jones Industrial Average was down for a pre-election year. On this chart, we've got a few lines here to sort of compare the action for the S&P since 1930. Excuse me. In the pink and green line is all years, not pre-election, just every single year since 88 in the green and since 1950, just to give a little baseline of the average year. And the blue is all pre-election years, nice and strong, up high, the best year of the 4-year cycle. And in the black is the 7th years of the terms, the second pre-election year. You can see the effect of 87 here, but considerably weaker. And throughout this year, on our blog and in the newsletter, we track this with the red line of 2015. Sort of following the trend of that 7th year, and then sort of separate here. This decline is very similar, but a little bit steeper and earlier, and we did not get the December rally that we've had in previous years, in all years, in pre-election years, and 7th years, which is of concern here. So we ended the year negative, but just because 1940 and 1941 were so horrible after the last Dow losing pre-election year under FDR, it's not necessarily, means that we're going to have horrible years going forward. We've got, we don't quite have, the action that we had going on in Europe or around the world, though there are some concerns with things going on in ISIL and North Korea and Saudi Arabia and Iran. So hindsight might prove a little clearer, but right now it doesn't appear that we're at the outset of such a wartime period as we had in 1939. Jumping through to the seasonals, last year things were looking even real strong in November after we had our buy signal. This is using the MACD. I don't know how many of you are technical, but a quick rundown. We used the 817.9 on the buy side. We had a crossover from the MACD line. We do discuss some of this further on our website. We had a nice sell signal here. In April, everyone was giving us a little bit of flack because we get out early. We missed the ultimate high, but we don't we try not, I mean, everyone tries to pick tops and bottoms, but we don't claim that we can. We're looking for the bigger moves. So we avoided a lot of this carnage. We got back in on October 5th. After we cleared, we've got this little W123 bottom I'll show you in a second. So all in all, a pretty decent seasonal year. We had most of the action from October 2014 through the spring of 2015. Not much during the worst 6 months. We got a nice bounce in October. Right now, I'm a little bit concerned with the action in the current best 6 months. If you remember back to 2007, 2008, when we sort of topped out in October and had a horrible best 6 months from November through April or October through March period, that was an indication for us that things were awry. Old school analyst Edson Gould, findings and forecasts was his newsletter. Was his old newsletter. I think we lost him in '87. One of his lines was, I may butcher it, that if the market fails to go up during the favorable season or the bullish season, that means there are other factors at play, and when that season is over, watch out. So another thing to keep an eye on, as seasonals are not only a tradable strategy, but also an indication when a really consistent seasonal pattern does not materialize. A little sort of esoteric pattern that was useful this time around. Sometimes it's not, but it's called Three Peaks in a Domed House by another late great man, George Lindsay, who was kind of a savant. I don't think anyone can repeat what he did. He called the market for a decade in 1969 when in the Almanac, and Yale printed it. But this is something that I was sort of egged on to keep track of by Doug Cass. And you see these three peaks over here, this little domed house with these different points, if those of you that know it. And we did come down and break through. We had this separating decline where we break lower than one of these troughs here. And then after this, we had this nice W123 bottom, swing bottom here, and we break above this middle point. We had a MACD buy signal. Then we have this crossover from the 50-day to 200-day. So all in all, a little while ago, about a month or so ago, things were looking pretty strong. Right now, we are sort of on the cusp. This is yesterday's close of potentially breaking this support here, this sort of middle point of the 123 bottom, and also this descending flag. Now, classic technical analysis suggests that a descending flag is bullish and that it usually about 87% of the time it breaks out higher. This is a bit longer than others, and this period of lower highs and lower lows has us concerned and on the lookout. So a little technical look there. Now let's check in with Santa. The old line from our songwriting founder, Yale Hirsch, still kicking at 92, not too far away from me, is if Santa Claus should fail to call, bears may come to Broad Wall, but you kind of have to watch out now. Santa Claus is the first of our January indicator trifecta. It did not come in. You can see the last several times that we did not get a Santa Claus rally the last 5 days of the year, plus the first two of the new year. Not that, year-end rally that everyone starts talking about at Halloween or Thanksgiving, but this short little rally that Yale discovered back in '72. So the times when it's normally a bullish bias there. So a lot of retail people are away and the pros are on the floors or desks and buying up, beating down stocks at year end. It's usually a bullish bias there, average about 1.4% in the S&P since 1950. When it doesn't happen, we have had flat years and bear markets in 2000, pretty nasty one in 2008. Last year, we had a flat year, kind of negative. Remains to be seen if this is a bear market. In the making, I'm not convinced yet, and we will hold out our, any change to our forecast or any really, bearish call if it is warranted until we get to the end of January. So, including this year, we've got 15 years since 1950 where the Santa Claus rally was down. And then we've highlighted the years in sort of gray here when the first 5 days indicator was down and the whole month January barometer was down. And you can see that there was only one decent year when you had all three down, and that was '82, aforementioned the last, secular bear market liftoff point. So we'll be watching those other January factors, but the performance since 2000 has been pretty bad. In January, pretty volatile. We've had some big ones, some bad ones. We had a couple down in a row. I think the action this January will be critical, perhaps even a little bit self-fulfilling, as a lot of people are keyed on it and watching it right now. So we'll be looking at that indicator trifecta of the Santa Claus rally, the first 5 days, and the January barometer, and additionally, something known as the December low indicator, which comes via Jeff saw it at Raymond James. It's one of the pages in the almanac, and it's from a old analyst, writer on the street, Lucian Hooper, who found that, if the Dow closes below its December closing low in the first quarter of the next year, it's a warning sign. So watch out. So that could happen today. It almost happened the past couple of days. So keep an eye on that. And if the trifecta is all negative and the December low gets broken, it's going to be hard to stay bullish. I'll tell you that. And also, we've got this small cap effect just being missing in action. The Russell 2000 is lagging. Normally, this is the time of the year where small caps outperform large caps. Another reason that we're concerned is that we're not getting that usual small cap outperformance. Let's take a little look at the election year pattern here. We've got, one of these one-year seasonal pattern charts that we like to evaluate things with. All presidential election years see about 4.8% or so, a little bit more back to 1930. And then you've got just 8th years. That's the second election year, the one that Obama's in right now, where they're not running for re-election. You have sort of a lame duck action here. And this is the S&P in the chart. And over here, there's some numbers for the Dow, which has an additional one back in 1920 with Wilson. Of the 6 previous 8th years of presidential terms, only one was up, and up only a bit, and it's an average of about minus 13.9% down on the Dow, and about 10% on the S&P, 10.9 I think it is. So one of the factors that we are concerned about. And then the topic I went on CNBC yesterday to discuss was this potential Dow theory sell signal. Richard Russell, RIP, had the pleasure of communicating with him over the years. Dow theory letters out there in California. I think he was about 91 when he left us late last year. So we have the comparison of the industrials on top, the transports in the middle, and the utilities down here. Just drew a couple, peak to trough lines here to give you an idea. And the thinking here behind the Dow theory is that the transports need to confirm the industrials. So if the industrials are producing a lot of goods and the transports aren't delivering them, something's amiss, and there's this lack of agreement with the 3 major Dow averages, creates a warning sign. And here we are in a bear market for the transports, and we're sort of have been struggling with this top since all of last year. So, we've got some issues here. I'm concerned. So let's just take a look at some of the pros and cons of the forecasting right here. Admittedly, I tried to put some more pros in here. There's a lot of negative things going on right now with the market falling apart. So we've had the first down pre-election year. We've got this long descending flag. The economy's rather tepid. We have a Dow theory sell, no Santa Claus rally. On the bullish side or the pro side, seasonally we're in pretty good shape. We're in the great period. We're still holding support. Remains to be seen today and later this week. Election years are historically bullish, despite the 8th year, which is a small statistical sampling of 6. A shorter term descending flag is bullish. That's there. We had this bottom in place, and the December low is still holding. Again, that's on notice today. So just a quick look at the basket of sector ETFs that we have in the newsletter portfolio. This is a combination of our seasonal and technical work, leaning a little heavily on seasonal for the sector trades. This is the basis for the sector rotation strategy that Dave and the folks at Probabilities Fund Management are running. Right now, it's up for about a year. Last I checked, it was outpacing the S&P at the end of November. We don't have the end of December numbers yet. That's a official strategy there. So I believe the XLE has been stopped out now. Gold's looking pretty good. This bond short still holding up. The biotech we picked up nicely after that Hillary Clinton tweet. We got stopped out and then back in with our October buy signal. So just to look at how you can see the dates very clustered in September and October for the buys. Earlier in the year, we had some short positions in materials and other things, which boded well for us. This might be tough to see in your screen. This is on our website. If you're a subscriber, you can look at it. If you're not, you can take out a free trial for 7 days, or I have a little subscription offer at the end if you want to have a little discount and see what we're doing here. So you can see a bunch of different, this was our basket that we put out at the bottom here. I think we're in almost all of these. Southern Copper was a seasonal copper commodity trade with the correlated stock. The rest of these are fundamentally selected. A couple left over from previous years in 2012 and 2013. Again, one of our mantras is, let your winners ride, sell your losers. We also do a little sell half on a double, especially with the smaller caps. And this has inspired us to start another strategy with Probabilities Fund Management, where they have just begun on January 1st a stock basket strategy where we selected another basket for them of about 35 stocks, small, mid, and large cap at year end. And then one of our favorite strategies has worked quite substantially. This is the free lunch strategy. We call it sort of tongue-in-cheek, the only free lunch on Wall Street, because it was JP Morgan that said that. And last year it wasn't that great. We had some trouble in January, but this year it's off to a pretty good start. And basically what we do is towards the end of the year, and when it's been proven or we've shown over the years that stocks making new 52-week lows outperform the New York Stock Exchange Composite by mid-February. We have a couple of tweaks. We like to get in a little bit later in December when tax loss selling has abated, try to capitalize on the small cap rally and the Santa Claus rally. Not that we're having either of those this year, but we're benefiting from some of this energy bounce. Notice there's a lot of oil and gas and material stocks. So this year's basket was up, this was from yesterday, up about 6% versus the market, which is, down a little bit, and even more so today. So despite a negative Santa Claus rally and a poor start to 2016, this basket of stocks has a little bit of life in it still. This is a real short-term trading strategy. You sell any quick pops, you dump anything that's falling apart. Some of them could be dogs. We usually take quite a bit of time and go through these and make sure there's no glaring errors and that there's a decent amount of liquidity. So there's a nice strategy that we do at year end. And with that, let's just jump into our forecast and outlook, something we do every year just before, just before Christmas or triple witching. And we kind of look at a lot of the factors that we look at every year, and they are the industrials, which I still think is one of the most influential indexes out there. A lot of folks will think it's antiquated, but it's still it's been improved, and it's still a basket of about the 30 most influential companies on the planet. We look at this is what we call the four horsemen of the economy: the Dow, the unemployment rate, inflation, and consumer confidence. And we also look at housing, because that's a real just great indication of what's going on in the country and the economy. So this was coming from a forecast we put out on December 17th. So things are changing a little bit here, with Santa's tail between his legs and North Korea supposedly setting off some H-bomb. I'm not sure that that's real, but they did something. China's having some issues. The Saudi Arabia-Iran confrontation, rates are picked up. We've got commodity prices. So we're at a relatively critical juncture right here. So let's look at some of these charts. We've looked at the Dow quite a bit. So you can see the unemployment rate going down very nicely. As we all know in this business, it's not incredibly representational of what's really going on out there in the world. There's this participation rate we talk about. Made the same comment to Joe Kernan yesterday on air that, once you get outside of Rome or New York City or Chicago or the big urban centers, it's rough out there. People have 2-3 jobs to make one whole job. They're working part-time. It's not as rosy as it looks to the folks in Lower Manhattan or Chicago, San Francisco, et cetera. So it's been in a steady downtrend for the past 6 years. Again, that participation rate is battling to expand. But despite a lot of likely layoffs in the energy patch, some solid hiring, most likely in the healthcare and tech sectors, are sort of keeping the unemployment rate up. Inflation, or lack thereof, it's part of the dual mandate of the Fed, and it was clearly, driving that long delay in raising rates. Both the PPI and CPI, and this is a plotting of a 6-month exponential moving average, so we can sort of smooth it a little bit and smooth out some of the volatility, so we can see the trend here. So it's been sliding for over a year, and we've taken a nosedive here with the PPI into negative territory. We've got, commodity prices plunging, oil prices plunging. So now that the Fed has raised rates a whole quarter of a point, perhaps this low inflation or disinflation will prove transitory, but it is rather worrisome. Consumer confidence continues to trend higher, and it's above this critical 90 level, but it has broken down a little bit, and it's threatening to break down even further if things don't pick up in the economy and the market. So housing, one of the brighter spots is existing home sales. Housing starts, remain on the rise, which is on the next chart, but this is by far the shining data point, and it's coming in at well over 5 million at a seasonally adjusted rate for the last year and a half, so that's encouraging. But starts over here, not gaining as much traction, a concern. That's probably the last thing to really fall into place for the housing market and the economy. Builders and financiers and banks having confidence to really start building a lot of new houses and getting rid of the glut that was there. New home sales, again, one of the final factors. After all the existing homes are sold or used up, new home sales kind of remains down in the sewer here, and it's a concern for the housing market. And when we see this new home sales pick up, I think we will have a good indication that we've begun the next secular boom. And the leading indicator, the HMI, the National Association of Home Builders Housing Market Index, has been doing quite better overall, but it has been rolling over. I think the next data point's even a little bit lower. That just came out after we published this. It led all other indicators back here in 05, 06. You can see it started going down before the market topped. So this is something to watch. Hopefully we'll look for it to hold above this midpoint here, which would be an indication that things are healthy in the economy. So one of our other features in the newsletter service, so I didn't even put that in there. I think I pasted it somewhere else, is our pulse of the market. You'll have to forgive me for that. Perhaps I can grab that and show it to you. Let's see. Because there's something really crucial going on here. But maybe it's not possible to do that. Maybe I can just look at it. Look at that. There we go. Sorry about that. I saved it in 2 places. Back in action. One of the crucial things here is this down Friday, down Monday. You can see back in August when the Dow has a down Friday, down Monday, it can be quite of a warning sign, but here we had that low point, that bottom. Perhaps we're seeing some similar action here in December, January. The last couple of weeks, we've got down Friday, down Monday, back to back. Will remains to be seen. One of the other concerning things is this market breadth. This is the market internals that we look at, where we've got some solid advancers on weeks that things were up, decliners down, but when the market's down, we're not seeing any underlying support from the broad market. New highs have started to pick up a little bit here, but not very encouraging. New lows have come back after getting hammered towards the end of the year. We'll be looking for this improvement in this area in internals, declines and advancers, decliners going down, lows going down, and advancers and highs coming up before we can get comfortable with the market going to new heights. So let's take a look at the forecast. Review some of the things that we've done here. Election years on average, the Dow's up 4.8%, but as I mentioned, the 8th year's average, minus 13.9, down 5 of the last 6. We mentioned the Dow was down for the first time in a pre-election year in 1939. It doesn't necessarily mean that we've got trouble ahead for this year and next year, but we've got some issues overseas, and we've got some issues with the Islamic State. Korea now's, I guess, probably jealous that it's not getting the attention. Iran and Saudi Arabia are going at it. We would also not be surprised if Russia comes in and does something unilaterally with ISIL. They want stability in that region, and perhaps the wisdom of the first Mr. Bush president and Powell and Schwarzkopf to not go in and take out Saddam back in '91 and leave the lesser evil of the despot there unable to harm his neighbors. Something's to be said for that. So we see two scenarios for 2016. If the Fed is right and these energy and commodity declines are transitory, prices stabilize, we'll look for average election year gains in the mid-single digits. If not, and we continue to suffer declines in the commodity patch and the junk bond scenario starts to unravel, we may begin a mild bear market. In fact, we may already be in it. I'm not convinced just yet. We will reassess at the end of January, looking at our indicator trifecta, the next two coming in the first 5 days of January barometer plus this December low, which by the end of the day, we might know if that's given us a warning sign. And of course, we'll evaluate economic data and political commentary from DC and around the world and what's going on geopolitically at that time. We may begin that next bear market this year, maybe already begun already, could be a little bit later, but one way or another, we're expecting a bear market over the next couple of years to bottom in maybe 2017, 2018, with about a 20 to 30% pullback, what we would call the last cyclical, almost garden variety bear market that puts an end to the secular bear that began in early 2000. I'll show you a little bit about that in a second. There's some charts on that. But either way, we don't expect much upside over the next few years at all in the market. But after that next bear market, we look for our super boom forecast to kick in based upon the cycle that Yale discovered back in '74. We have lifted up the floor of our initial forecast, but the 500% move to Dow 38,820 by 2025 is still on target. And that is based upon a 500% move from the intraday low on March 6th of 6270, if memory serves. So here's the chart. What my friend Josh Brown, the reform broker, called the greatest chart on earth. This is a redraw of what Yale put in the newsletter back in '76. And you can see we've laid out, it's a log scale. We've laid out the CPI in the pink line. We've got the Dow with some gray shaded areas over the secular bear markets. You can see this is updated about March. We've got some points on the chart indicating where these cycles begin. Many folks get caught in the sort of symmetrical cyclical pattern. I know that sounds a little bit odd, but the 17.5-year cycle, the 16-year bear market cycle. Well, if you look back, you've got a very short bull market in 29, about 8 years. You've got a very long bear cycle from whether it be 29 or from this period here in World War II. Vietnam was a bit longer. This long up pattern was a bit longer. So we think it's more event driven. That's why we've labeled some of the beginnings and ends of these things. Likely the 9/11 point was the beginning of the current secular bear market, or the year 2000, the war on terror. Even though we've poked above this high back in 2007, if you look at the S&P and the NASDAQ, it's a little more matching of the sort of pattern during NOM. So we're looking for this final 82 moment over here coming up on the other side before we take off to the next secular bull market. Nobody claims that the secular bull market began back here in 1974. Everyone's pretty much in agreement that it began in 82. So we're looking for a similar moment there. When I put out that forecast in March 2011 in the book Super Boom, our publisher Wiley asked us to put some projection together. So initially we drew this blue line of the forecast from April 2011 based upon all the secular bull and bear action and seasonal and 4-year cycle action that I could compare and sort of consolidate together. The black line at the time was right here. That's the actual monthly closes of the Dow. And then as QE kicked in, we made an adjustment over here in January 2014, sort of raised the floor, as I mentioned, using some of the factors that we knew were at hand with basically pulling out of Afghanistan. That may change now. There are, a couple of factors that need to come into play here. We still have this war dragging on here. I adjusted again in 2014 and then recently in March, and it looks like we're sort of tracking back into the previous 2 iterations. So just want to keep track of our thinking, and it's okay to update a forecast and change with the data and factors at hand there. So a couple of factors need to fall into place before this to happen. First, we need some inflation. We do have some starting back from 2001 when this whole secular bear started, about 30% or so on the CPI, but it's been coming down since then. So we'll need to get inflation to pick up a bit and then level off. We'll need some political functionality down in DC, around the world. We don't have that right now at all. There's a lot of bickering and not a lot of, working with the private sector, at least getting out of the way like we had with Reagan and Tip O'Neill and even Gingrich and the first Clinton. Maybe that was a Freudian slip. Not that I'm voting for anybody, but it's looking likely that Mrs. Clinton, I would say, is the leading, at least in the polls, person to be in the White House next. And then we'll need some enabling technology, what we call a paradigm shifting, culturally enabling technology, like the automobile from the 20s, which really kicked in during the roaring 20s, and the TV and appliances in the 50s and 60s. And then, of course, the information revolution with the chip and the TCP/IP protocol and cell phones and all that stuff. So that's the longer term outlook. And but it's a little bit murky for the next couple of years, as you can see here. Somewhere in this area, no one claims, and I personally don't claim to make this exact forecast, but this is a projection. So with that, I want to, go over a couple of things. You guys can continue to, do this yourself with the Stock Traders Almanac and all the other tools. I invite you to come and join us at stocktradersalmanac.com for a subscription. It's a digital subscription service. We do bi-weekly research and alerts with different market analysis and recommendations to stock selections, ETFs, and it comes with the Stock Traders Almanac. If you want to get 10% off, a little Happy New Year special for the monthly subscription, you got HNY 16M, and then Y1 for a 1 year and Y2 for a 2-year subscription. And you could also consider checking out some of the offerings of Probabilities Fund Management. I'm an investment committee member there. They've been using my research to create and implement strategies and portfolios. There is a mutual fund, PROTX, Probabilities Fund. They have a tactical long-short U.S. equity and sector rotation. And we just started a new Almanac Trader stock fund with our stock picks. And I'm going to let Dave Rabin discuss a few of these things with you. So without further ado, Dave, why don't you share a couple words?
Thanks, Jeff. Appreciate you allowing us to be part of your presentation. So Jeff is a member of our investment committee. He's a consultant to us, and one of the reasons is we use quite a bit of information, quite a bit of the research from Stock Traders Almanac and Jeff's firm. We have the unique ability to take this research and basically turn the information into knowledge. So it's a way for individuals out there, advisors, and their clients to directly benefit from the research presented in the Stock Traders Almanac. A little bit about Probabilities Fund Management LLC. We are a registered investment advisor with the SEC. We're located in San Diego, California. I would welcome you if you want some additional information on our strategies or how to take advantage of it. You see the website in front of you. Feel free to click through strategies and so forth. There's also a contact us phone number and email, so if you do want some additional information. But we run 3 strategies. Our flagship strategy is the long-short equity strategy. We have an 8-year track record on that, and again, we utilize a lot of the research. Basically, our long-short equity strategy is more of a broad market strategy, mimicking the S&P 500. We go long, we go short, we also sit in cash, and we manage that utilizing ETFs. The second strategy, which we just launched last year, had a positive year-end, is our probability sector rotation. And again, it's a long-short sector strategy. We look at the S&P sectors, and we're either going to be long one of the sectors, we're going to be short the S&P sector, or the sector would be neutral for us and it would be a cash position. So very unique out there in the industry. If you are familiar with sector rotation strategies, most of them are more of a relative strength type of strategy, and ours is quite a bit different. We're excited that that's going to be launching as a mutual fund this year as well. And then we're really excited of our newer strategy where we're directly implementing Jeff's research and the Probability Almanac Trader Fund, which for the most part is an all-cap, all-sector, long-short, using individual stock positions. So yes, we launched that January of this year, running it as a separately managed account and soon to be offered as a mutual fund. So again, I just wanted to thank Jeff and the folks at Stock Traders Almanac for allowing us the opportunity to speak with the audience. And I think, you know, we do have a few questions, and when we talk to advisors about our strategies and mention some of the research, one of the overwhelming questions we get is what the Fed did last year and how that affects the research going forward. So I'm going to kick this off as far as questions go and turn this over to Jeff. We all know the Fed raised rates last year. So based on the research, Jeff, that you guys are doing at your firm, what's the effect? Have things changed when the Fed does raise rates and there's increase in interest rate based on the historical research? And in the long run, I mean, what effect is that going to have on the market short term, long term?
Well, I mean, we've carried this and we updated again as soon as the Fed raised rates. I mean, there is a negative bias after the Fed begins a tightening cycle. One of the things that we thought was different this time was that it was so telegraphed, more so than ever before. But it's 3 steps and a stumble. I mean, there is on the averages, it's not that red, but down a few percent. But considering all other factors and what we're seeing here, it's looking like this pulling of the punch bowl, or at least even the fear of more of it, is negative. But in general, rising interest rate environments are not great for the market, and it's sort of already proving itself to be the case. We had a good day, and then all the other factors seem to have weighed on that heavily, and I'm not convinced that they're going to keep tightening if the market keeps going down like this. So, Dave, I really thank you for that and for being part of probabilities. And there's a few questions that have come in already. Thanks, Stephen, for shaking my hand at the Stand Zone conference in London. That was a great show. Appreciate that. In your opinion, I'm going to read the question that I'll try to answer. And if anyone has them, keep sending them in, and I will go as far as we can until I run out of breath. So, in your opinion, is a global day one opening down a bearish sign per se? Day one, not necessarily, Mike. Day one has been negative. Day two here is more concerning. That's been a much more bullish day. We've seen a lot of profit taking on the first trading day of the year now. So more concerned about the Santa Claus rally in the first 5 days and the whole month of January, as opposed to just the first trading day of the year. Gloria said the buy indicator settings of the MACD was 817.9. Right, exactly. The sell is 1225.9. Also, that piece of software I have has a little F there for the, I'm not exactly sure what their nomenclature is, but it's 9, and I've plugged it in there, and that's what we use. We also run it in Excel and a spreadsheet to make sure. Patricia, yes, it's recorded. We will email everyone afterwards to make sure that you get it. And Rob Osdale, another committee member. How you doing, Rob? It looks like the transports are confirming the theory. In that case, am I missing something? No, not necessarily. I mean, I think it's another negative factor. I don't think the Dow theory sell signal in and of itself is the death knell for the market, but all these other factors, and you start adding up Santa not showing up, or that bullish rally, some of the other market action, I think it's definitely one of the cons up there. Jack, the webinar will be over whenever we finish the questions, probably around 2 o'clock. Do I have any relationship to Courtney Smith? No, I know the name though. You're welcome, Gloria. The PowerPoint slides can be made available. Yes. When we email you, you can reply or email us. Go to stocktradersalmanac.com and send us an email from one of the contact numbers there. Brett, 2002 to 2008 rally in oil equals 9/11 premium. Now just back to normal. That's a decent point. Yeah, perhaps. I think it's a bit oversold on the oil end. Is there a Trader's Almanac for futures? Yvonne, we used to do something called the Commodity Trader's Almanac. There wasn't enough interest in it, so we weren't selling enough of them to do it, but we cover all that Trader's Almanac for futures and even some Forex, the pound, the euro, and the yen mostly, in our newsletter service at stocktradersalmanac.com. You can see some of those trades in there. That copper trade I talked about is right out of the Commodity Traders Almanac. Almanac. John says, do you think a shooting war between the Arab states can occur soon? What effect could it have for the markets? I would think it would initially be negative. I think it's hard for them to have a shooting war right now. They had enough trouble going after ISIL themselves. I assume you're talking about, Saudi Arabia and Iran. But it is looking like a bit more of a powder keg than it has in a while. That would probably be a negative, and it would probably create a great buying opportunity, and maybe the impetus for that bear market that I'm expecting. Could be another factor as well. Mark, do you see a perfect storm situation where equities struggle and bonds get beat up because of increasing rates? It's it's looking like that. I mean, gold's been down so much that might be a place to go. That may be part of the storm that's weighing on the market right here. Equities are in trouble, bonds are in trouble. So I don't know if I'd call it a perfect storm, but maybe a 1-2 punch. Dave, your presentation seems to give a negative picture for 2016. Yeah, maybe 3 days ago it would have been less negative. But advice for retail investors: back to cash, ditch worst performers. I think all that, follow the almanac most definitely. I think caution is in order right here. Let's wait to the end of January. Sell big losers, hold on to winners, be patient. All those things. I think you got to be real aggressive and tactical. I don't mean aggressive long. I mean active on your portfolio if you're managing yourself. And you're a short-term trader. Long-term people, you got to sit tight. We're just talking to Joe Childry the other day with the market down, and it's a great time to get into probabilities fund when the market's down like this. If so, any ideas where to go? I mean, some of the sectors we have in there, I think, pretty strong. Biotech, I think, is a sector for the future and the present. You can use some of this weakness to trade it. But I'd be cautious, especially, if January's down and we cross that December low indicator and just sort of, tightening up stops and thinning out losers and being prepared to take some defensive positions on the short side or on the inverse side with all the ETFs we have. When you may know if we are already in a bear market. Oh, I wish I could tell you that. It was pretty clear in March 08 that we were in one. I think we need a little bit more hindsight to know that. I've got some other colleagues who are thinking we're already in there. I'm not convinced just yet. What would backtesting returns have been for 2015 on the new Almanac Traders Fund? Great question. I think you can see it in our stock portfolio that I showed you here, give you a little idea. It wouldn't be exact, but this is kind of what we did here. You have sort of the 1 year change, a couple of percent on the small caps, 9.6 in the mid caps, and 8.2 in the large caps. Again, seeing the underperformance in the small caps there. So that should give you a little bit of an answer. And we've got some, you can look at some of the other returns on the website. Jeff from Chet, are you concerned about the fact that most of the leadership in the market last year came from 11 stocks? Very narrow. Yes, quite concerned. That's why we look at market internals. That's why we look at advanced declines and new highs and new lows. I think that is a major concern. It helps to own the QQQ. Bonds do have a seasonal pattern. Basically, Brett, it is the inverse of stocks, and that's why we have a short position on that TLT that I showed you there earlier. Charlie, some gurus point to credit spreads as being one of the most important leading market indicators. Do you weigh this in your forecast? I do somewhat. It's not, one of my major indicators, but credit spreads are very important. The bond market is basically leads the stock market, and I think it is quite important, and we do weigh that a bit. Would you recommend going to cash based on the markets today? If you were a money management client, I would make a specific recommendation to you on going to cash. I wouldn't recommend doing anything rash at this moment. Thank you, Daniel. Appreciate that. Multi-generational expertise. I do still have the privilege of bouncing some things off the big guy, Yale, from time to time. Thank you, Yvonne. Jerry, given downward forecast, not through 2019, I don't think so. Best 6 months will be quite valid during that period. I think that's when seasonals will even be more effective during this bear market period. We avoided many a decline in recent years and in the past using the best 6 months. And that's one of the real crux of the efficacy and benefit of the seasonal strategy, especially the best 6 months, is that most of those declines, or the bulk of those declines, has taken place in those worst 6 months. May through October, we've seen so many October bottoms. I think it was 9 of the last, or 10 of the last 16 bear market bottoms have occurred in October. So it's, I'll have to check that fact, but it's a big number. So I think seasonals are especially important in bear markets. Will we get the March to April run? Let's get through January first, Ted. You know, I don't trade on hope, and it's not clear yet if that's going to happen. On paper, seasonally, yes, we would expect that, especially after, a sell-off at the end of the first quarter, which is very typical on a quarterly seasonal basis. But I, I'm not convinced that we're not going to have it just yet. But if things fall apart here in January, we might get another type of '08. Not quite as deep as '08, but that's sort of, when the seasonal period's over, after it sort of goes sideways, we get a little rollover when the seasonal factors are taken away. So, Stephen, would you see 2016 as a pick and mix year with regard to equities if you're going to make money? I see most years like that, some more so than others, and I think 2016 is setting up to be, a more nimble, less straight long and momentum play type of year. So I think that it is a more, as you said, pick and mix type of year. Dow December low, Yvonne. Can you provide additional comments on this? Dow is currently at what actions would you be based on that as a retail trader? Again, it's nothing incredibly rash, but you got to change your. If we break the December low, that's the on top of not having a Santa Claus rally, that's another factor. If you have an almanac, you can see the results on page 44 of the 2016 almanac. Combined with the January barometer, it's a really powerful indicator. So I would, at a bare minimum, cut some losers and not get in a whole lot of longs and just be a little bit more patient and just cautious. At the opening of the market, this day was almost exactly like day one a year ago. Interesting, Ted. It does feel a lot like the last couple of Januaries. Daniel, great question. If you think the removal of stops and good to cancel orders will impact the normal market cycles, I'm not convinced it'll impact the normal market cycles. I think it might impact, individual results. But as we saw the T-3, the 3-day settlement, not really change things that much. I think it sort of pushed the tax loss selling a little bit later into December, so it might shift it a little bit. But again, the other thing I noticed is with high frequency traders, high frequency trading, there is a lot of chatter about how that's impacted the market. But what we've seen in our intraday trading patterns in the back of the almanac on page 140, or is it 130? Yeah, 139 and 140. The intraday market patterns based upon the half-hourly movements of the Dow have not changed much at all with the impact of high-frequency trading. So I wouldn't be so convinced that will impact the market cycles so much with removal of stops and GTC. Alan, if you believe we're in a bear market period, then wouldn't you buy bonds now ahead of a further decline in the stock market? I do not necessarily believe we're in a bear market period at this exact junction. At that time when I do, I would do more than just buy bonds. But yes, I would take defensive action. Can you comment on the yield curve and why you are more bearish and comment on this fact? There's never been a bear market that was not preceded by a negative yield curve. I'd have to check that. There's been some bear markets without a negative yield curve, some of the shorter term ones. I don't know if you're talking about a long-term one. I'm not talking about a massive, bear market, just more of the garden variety 20-30% time. That's a pretty good, I'd have to look at that a little more closely, Zarino, but we might get a flip in the yield curve, but I think there's some instances where that has not been the case. So I think we've gone just a little bit past 2 o'clock. I'm going to wrap it up here. I don't see any more questions. I want to thank everybody for attending, and feel free to reach out to us over the internet or any other way that you can get in touch with us. I will be doing a few things. If you're in the Boston area, I'll be speaking to a small investment group up there, the special retirement investing special investment group, I think it is. I'll be at the Traders Expo in New York City in February, Orlando Money Show in March, and then I'm going to go to the Palm Beach Traders Group on March 8th for the Money Show. And I'm always available for conferences and workshops and meetings and client events. So thank you all. Yes, we are planning on doing other webinars, Patricia, especially with the great turnout today. I want to thank you all again for that. The code discount will expire. I think we've got it through March for the first quarter. Thanks, Rob. And we will look for comments and follow-ups if anybody wants the slides. Yes, we'll offer the recording. If you're registered for this, you'll get an email for it. And you can share it with any of your friends that signed up that were not able to attend. And if you want, before I sign off, I'll show you those codes again. For the monthly subscription, they're all HNY, Happy New Year, 16 monthly. 1 year, I put Y1, and 2 year, Y2. That gets you 10% off. The annual NQ, no worries, Peter. You can hear it again and get the slides. Just reach out to us if you need something else through stocktradersalmanac.com, and hopefully we'll hear from you all or some of you with any more wonderful questions. And if you need any help with anything, and if you need some more information on probabilities, you can call me or go straight to Dave and the group out there. So with that, I am going to wrap it up and wish everyone a happy new year and a great day, and trade carefully. Take care. Thanks, everyone.